It's that time of the year when our inboxes are actually filled with season's greetings, our diets are actually filled with laddus and mithais. Stock markets, well, it's the festive optimism that we're talking about. Who better than someone who can decode this Diwali dhamaka for us? A man who's actually been ringing the bell for decades with good multi-baggers. We have Sunil Singhania joining in. Welcome to the show. Should I call you Sunil the multi-bagger? Because that's what I have known you since the time we started working in this industry. But Happy New Year and season's greetings to you and everyone at home as well. How would you actually look to decode this market right now? Because this Samvat has come in such a time where everyone is trying everything when it comes to domestic markets. You're looking at how do you spur demand from here on? The question is growth, the question is demand, lots that people are thinking about. How would you describe Samvat 2082?
First of all, happy Diwali to you and all the viewers, and thanks for the lovely compliments. When you say decades and decades, I start to feel very old.
Not at all.
So I think equity markets always have phases. And obviously, most of the phases for Indian equity markets have been great. But there are some phases where markets don't make you money or even give negative returns. And I think last 1 year has been that phase where I would say that given all the uncertainties, we have come out pretty well where, okay, we have not made great money, but we have not lost money. In fact, someone to Savat, equity returns in the equity markets are almost equal to the fixed income returns, But obviously, as human beings, we tend to be a little greedy. We've started comparing us with gold and silver and China and so on and so forth because of the last 1 year of recency bias. As far as the Indian economy is concerned, I think we went through some tough times last year. And predominantly, when elections happen, things do slow down. Politicians are busy, the government is busy. You have the code of conduct which comes into play, so new projects don't get launched or announced. Budget got deferred to July, and therefore the ministries got allocations only in August. And as a result of it, September 24 particularly was a very soft quarter with GDP growth of 5% and profit growth of only 3%. I think after that, every quarter we have inched up. We still are a little bit away as far as the corporate profit growth is concerned, but GDP is trended up well. In fact, June numbers were crazily high at 7.8. But we can say with a lot of confidence that we have reached the 6.5–7% of GDP growth. And we are very confident of profit picking up pace, and I'll come to that. I think globally also things have been very volatile, multiple wars and this tariff thing. And I think we are slowly getting over that.
So tell me one thing, what's happening in the markets right now is you're looking at expectations versus what is reality. Expectations were very high that the markets built taking the returns that people got during COVID, post-COVID, and that's what people are benchmarking returns to. How would you advise retail investors to actually navigate this kind of a situation? Because it's always the retail investors that get stuck, and we'll talk about IPOs also on this aspect, but it's the retailers who are the last leg.
In fact, I would say that retail India has matured significantly, and that's why you are seeing consistent maintenance of the SIP flows. So I think retail investors are now understanding that equity returns are not about 6 months or 1 year. Equity returns are a basket of 5, 10, 15 years. And as you rightly said, when markets do very well, which happened between 20 and 24, we start to believe that this is going to continue forever. And that has sort of been a little bit of a dampener in that respect. But when we meet our investors and when we talk to friends in the markets, I think investors are now pretty okay that if you are able to make 12, 14, 15% returns compounded in the equity markets year after year, they are pretty satisfied. I think obviously recency bias has crept in other asset classes. So now people have started talking about investing overseas, investing in gold, silver, because of what has happened over the last 6–8 months. And I think that is a circle. But I would say that retail investors have matured a lot. And our advice would be that don't lose confidence just because 6 months or 1 year returns have not been great. In fact, we are moving to a phase where definitely returns will start to show up.
Okay. So there are two sides to the story right now. We're talking about someone who's already invested, who's probably not lost money, but is pretty much at break-even right now, and someone who's probably looking to make fresh entries. Fresh entries, obviously, you're talking about something which is going to be upwards from here on. someone who's really been invested in the markets, is really being patient right now, would you say the pockets of opportunities then should differ? So let's talk about both of them. One, if you're looking at someone who's entering the markets now, what are the opportunities that you're seeing which they should start exploring now?
No, if someone is not invested in equity market so far, I think this is the best time to invest, and every time is the best time to invest, because this is the only asset class which will give you double-digit returns on a consistent basis. I don't see any other asset class giving that. So I don't think they should wait to say that now I'll invest or I'll wait and so on and so forth. Even those who invested pre-COVID saw a markdown of 25%, but from even the pre-COVID levels, markets are up 3x. The funds, markets are more than like 2.5 times. So I think for investors who have not invested, I think you should do it today. There's absolutely
but then the
no
debate
doubt.
comes in, Sunil, that should it be gold, silver or markets? And that's what you started off
I'm
with.
very clear. Last year I was a little bit more optimistic on gold. I'm very clear that 1 year return for gold and silver will be negative. That is my view. I'm not an expert.
Are you actually relating this to history, what has happened earlier? I think there was a time when silver touched
I don't
70,
track
75
gold
and then half.
I don't track gold and silver because there's no fundamental way of telling that gold should be at X price or Y price.
Okay.
You tell me one fundamental research or forward me one fundamental research on gold. It's all technicals.
Okay, so tell me one thing. Someone who has bought gold, has made the returns by now, would you say sell that and invest that money in equity?
If you are significantly overweight gold, you should definitely do it. But if you have just bought gold because every year we buy some gold, I don't think you're going to sell the gold at your house.
Yeah, because right now all housewives are talking to their husbands saying, I think we've made more returns than the investments that you've made in equity.
They are always right and they're always smarter. We don't have any debate about
that. Okay. So, but there are a lot of global companies as well, Sunil, right now when you talk about them, where the company's market cap itself is probably equivalent to our entire stock market's market cap. And that's where the question comes in, are there more opportunities in the domestic market, or people should start diversifying to overseas opportunities as well? How would you look at that angle?
See, one is, the few companies you mentioned where their market cap are equivalent to our market cap, say Nvidia or even Apple or Microsoft. These are not US companies, these are global companies. More of their revenues come from outside of the US and they cater to the entire world. So I don't think it's a right way of saying that, one company's market cap is equal to India's market cap. But at the same time, looking at the size of India and looking at the pathway ahead in terms of growth, very clearly India has huge potential and huge opportunity.
So where are you seeing the potential now?
No, we are equity guys. So
no, within equity, which are the baskets? Because currently, post GST, the thought process was it's going to be consumption driven. Now everyone is watching out for what do the GST collections look like. Has the pass-through happened? And if the pass-through has happened, it's more going to be of a volume game for consumption as well. I mean, you're not going to see that kind of reflection come in terms of profitability, in terms of margins, right? So again, the question is what happens to earnings of the consumption-driven companies. Secondly, the debate is now consumption versus capex. If the collections are not to that extent, will the government spend when it comes to capex?
So if an investor keeps on micro-analyzing stuff, they will not make any returns. I think from an investor's perspective, first be convinced that you have to invest in Indian equities. I think that is a bigger question. Coming to all you have mentioned, I think every sector will have their pluses and minuses, correct, but ultimately you'll have to take a view from a 3, 4, 5 years perspective. Just because GST is cut and near-term growth is there, not there, I don't think you're going to jump in and buy and sell anything and everything. It's more for traders. 2% bana ke nikal jao, that is not what we do. Okay, so everything you do is based on the perspective whether this company can double the profits in 5 years or 4 years. That is what we look at. Coming to sectors, obviously financials, we continue to be positive, but within the financial basket,
There are multiples that have got clubbed into financials.
Yeah, so it's changed. That is what I
Yeah.
was coming to. Financials is not only banks. Financials is now, capital market companies,
Correct.
asset management companies, wealth management companies, insurance companies, and so on and so forth. So one has to be, even within financials, be clear of what you want to invest in. Pharma is a good sector. Again, pharma is domestic pharma, global pharma, CDMO, API. Everyone will have their own dynamics, but we are positive. Metals selectively we are positive. I think capital goods we are selectively positive. India has long, again, roadway in terms of Make in India and even export opportunities. And some of the new age companies, I think eventually we'll have to take a look at them, because that is where our spending is happening.
Correct.
So I think India offers huge opportunity because it's such a diversified country. It's an entrepreneur-driven country, and I don't think we should get fixated with near term में 2% बढ़ा, 2% घटा, what you are saying, GST बढ़ा and घटा. I don't think we should get fixated.
So what you're saying is the growth story when it comes to India is intact, right? The government is pro-growth. The RBI now as well, with the way they've been acting with the rate cuts, they are also pro-growth, right? So, and now we're talking of Swadeshi, and that's what everyone is promoting. Do you think companies that are driven towards Swadeshi could be your growth drivers from here on? Because then, every sector will have some losers, will have some gainers. So I think that stock picking becomes absolutely crucial.
See, this word Swadeshi sounds good and we should do it, but it's very different from the Swadeshi movement of independence.
Correct.
This time it is very different. I think we should focus on Make in India where we can make in India. And we should encourage companies to see what is right now not made in India, whether over a period of time we can make in India. So there are some sectors which were low-hanging fruits, like electronics. We've started making in India. On textile front, on chemical front, the base raw materials, we are not making in India. We have started doing that. And I think it's a matter of time before some semiconductor facilities comes in. We are already seeing 3-4 groundbreaking happening there. We are already seeing on even the data center side, a lot of data centers being picked up. So I think it's a phenomena which should be encouraged by any progressive government. And good thing for us is that our government is also focused on Make in India and incentivizing manufacturing in India through various schemes, including PLI, lower income tax, and so on and so forth. So I think that is, again, a good segment. But as I said, India is diversified. India will be consumption. India will be infrastructure. India will be some base level sector like, the banks and so many other sectors. And India will also be some forward-looking sectors, which would be the data centers and the renewables and the AIs of the world. So I think you have to basically have a diversified portfolio and obviously have overweights on sectors which you feel are going to grow faster.
So within this basket also, I think, usually what happens, we see trends. Sunil Singhania ne ye stock liya hai aaj. Let's start looking at opportunities there. A lot of other investors like a Madhu Kela, you talk about Vijay Kedia, the moment, marquee names do come in for stocks, may it be a small cap, mid cap, whichever stocks, the retail investors run towards it. I'm sure there might be times where on some companies you will make money, some companies you will lose money. What should that retail investor do who's actually relying on not your advice, but it's more your action?
See, what happens is how does followers develop based on past.
Correct.
So investors have seen that some of these marquee names you mentioned have done more right than wrong in their life.
Absolutely.
And obviously that's why there is a follow-up which happens. Having said that, from a retail investor's perspective, one thing which we have to also realize is that every investor will have a different risk appetite. So an investor with 50,000 crores of net worth, if that investor buys 10 or 20 crores of a stock, you just can't blindly go and buy disproportionate to your net worth. Because it is always possible, as you rightly said, that any good investor can go wrong. And it is also possible that the sell-off and the sell-off you will not be able to know. So I think from an investor's perspective, it is good that you follow successful investors because they will be more right than wrong based on their past record. But at the same time, manage your risk internally.
I think that gets me to the question is, when to sell is the problem there, They've onboarded the journey, and then there might be times where the investor will realize, I think This is my risk appetite. It's given me the returns that I had to give my investors as well.
Borrowed information and knowledge will make you some income. They will never create wealth. So I think from a retail investor's perspective, there cannot be a better way of investing than just investing systematically in mutual funds.
I want to talk about that. You've just got the license for mutual funds as well. What is that thought process, as to why get into the mutual fund business, number one? Is it with the kind of boom that you're already seeing, the way SIPs have been panning out? Is that a better opportunity versus directly investing in equity then?
So directly investing in equity, one should do if you have obviously the time, you believe you have the expertise, and you also have the ability to hire people who can help you manage, direct investment, which I would say most people don't have. You are not going to be able to create a 20-member investment research team the way we have or some of the larger funds would have. And therefore, you'll always be at a disadvantage if you're an individual investor in a smaller scale. Obviously, large investors have created their own ecosystem. From our perspective, I think we went into PMS and AIF. We have done reasonably well. There is a lot of investors who basically feel let down because they don't have that kind of money to invest with us. And, obviously, there is a huge market to cater. The other thing, as you rightly said, is that the mutual fund industry is also evolving. So when I joined Reliance in 2003, we had to tell investors what is a mutual fund and why mutual fund and what is a SIP. We don't have to tell them now. So as we evolve, there will be more exotic or forward-looking products which will come in through the special investment fund and so on and so forth. So I think looking at the future, we decided to at least make a small foray into it. Frankly, from an individual, it is a very tough call because you are going to be pitched against the largest of largest banks who have unlimited branch network and unlimited net worth in terms of funds, and to that extent we will have to tread
What
cautiously.
is the fund going to focus on?
Equities.
Equities, but is there a particular genre that you're going to look at?
No, so I think the largest funds within the mutual fund equity side is the flexi cap.
Yeah.
So the idea is to start with that.
Okay.
But I think as we move forward, innovation is going to be the game. So next 3, 4, 5 years, we will try to create a separate niche where a few funds get sort of related with Abakkus rather than the run-of-the-mill products, which will also be there. Let's see. Josh bahut hai, ideas bahut hai. Now it depends on how people bless us.
Always blessed. But to this, Sunil, the other aspect is the hype in the IPOs market right now. And I remember the last conversation I've had with you, or probably before that as well, you've always mentioned that you've always related IPOs to a lot of the way new movies get released, right? Are you still of that opinion that an IPO is not something which you can actually take an informed decision with because of the limited data that is available? Because the euphoria is absolutely gung-ho right now. And the price that is in the grey market or the unlisted market versus jo issue price aata hai, there is so much of that differential that comes in. What do you do?
So IPOs, frankly, is needed in evolving economy because some of the new sectors, new sets of entrepreneurs, you will be able to only invest if the company does an IPO. Having said that, I think what has happened is few things. One is the pricing of IPO leaves nothing on the table, frankly.
For retail investors, and that's
Second is there are obviously not all IPO companies are great entrepreneurs. So one has to be careful about that. Third is, as you rightly said, that there is limited information. And you depend on what the management presents to you in half an hour, and you take a call of investing 200, 500 crores from a fund perspective in those companies. From a retail perspective, the only reason you are investing is because there is a grey market premium, not because you understand the fundamentals.
Exactly.
So one has to be very, very careful. My view is that 75% of the companies which are coming out with IPOs will trade below the IPO price in the next 6 months. But there will be a set of companies which will be interesting, where there is merit, and where that will be the only way you can look at investing, because they are coming fresh as far as listings.
So would you say that in terms of IPOs, if you have that bandwidth to play the volume game, yes. But as an investment, look at IPOs only post-listing and don't really go with the grey market premium.
What do you mean by the volume game?
See, a lot of people who invest only for listing day gains.
See, those are not investors, those are arbitragers. We are talking about investments. We are not talking about that category at all.
No, so you know what happens is, we speak to a lot of queries that we get, people ask us, listing day pe itna gain hai, ab itna gain aaya hai, so maybe the company will perform well.
I am not the person to answer that question, frankly. I have no idea about listing gains, what to do and not to do.
What I'm trying to ask you is, someone who's investing, is it better to take a call on an IPO once the stock is listed, to take some time to see how it is actually performing as a company and then look at IPOs? Because the valuations, as you mentioned,
for a retail
are really...
investor, frankly, again I'll highlight, if you don't have the wherewithal, avoid investing directly. Second is, good IPOs, why not apply? If you get allotment, it is good, because good IPOs normally will list at a premium. I'm talking about good IPOs.
Yeah.
But having said that, there have been companies which are good, which don't get that kind of opening, but eventually then they develop. There are so many IPOs which happened on the EMS side.
Yeah.
You got listing gains, but even after listing, if you bought, because these were good sectors, growing sectors, good companies, they have created a lot of wealth. Same thing has happened in some renewable companies. Same thing will happen in a lot of other companies which are listed. I think recently an electronic consumer brand got listed. Great response. The brand is good, growth is good. So I think selectively, good companies, you should definitely look at IPOs. But as I said, most of the IPOs are priced beyond perfection and not necessarily backed by good promoters.
Okay. Now, to take this conversation forward, IPOs is one aspect. We've spoken about the unlisted market. A couple of sectors that you mentioned about as well. How are you looking at IT as a sector right now as well? Because that's a sector which is actually down the dumps. A lot of dependency. You're talking about, will IT as a sector emerge as a domestic player now with the TCS coming up with a data center here? The others are still dilly-dally, no clear commentary coming in. Do you think this could be a time where you could look at smaller names which are supporting the IT sector as well when it comes to the data center business as a multi-bagger? Would you see opportunities there?
So one is IT services companies in India have global competitiveness, and hats off to them, because if IT services sector would not have been there last 30 years, India would have never been what it is today. So much employment, so much foreign exchange being earned by them, and they have brought India into the limelight as far as the global stage is concerned, so hats off to them. Having said that, growth has definitely slowed down. Earlier companies used to grow at 20-25%, then they started growing at 10-15%. Now the guidance from some of the larger companies is 4-5% growth, and we have to appreciate that. Near-term performance has been pretty bad, and therefore it makes sense for a rally, which has already happened. Results have not been as bad as investors and analysts were projecting, and therefore, I think things have settled down. Now, every company will try to have a path towards growth. If you are not able to grow in what you're doing, you will try to see whether there is growth which is possible in some of the allied sectors. And maybe the company you're mentioning saw that. Some other company might not have that view.
Got it.
Because IT services predominantly was low capex oriented, high ROE services business. Once you get into data center, then you're transforming the business and you're becoming a high capital intensive, business.
It's a different business
model.
So
not all companies might be willing to do it. So I think for each, they will do what they believe is going to be the fact. But I'm very sure that forward-looking entrepreneurs will try to see how they can deploy the huge cash generation, which they will do. So all said and done, IT services companies generate a lot of cash. So they'll have to either do buyback or dividends, or they will say, okay, I can deploy this myself in a much better way. So it will be an evolving space.
My last question over here is, I think, and this is more of a advice to our investor right now. A lot of times we hear of people saying that, हम लोग ने Infosys खरीद के घर बनाए. I know I don't want to tell you, give a stock to any of the investors, but one sector or one space which you would say that, look at this space closely and probably you will be able to build a house in the next 10, 15 years like what happened with an Infosys. What
say
would you peg that with?
More investors have built houses by systematically investing in mutual funds.
That is it.
Reliance Growth Fund, which is now Nippon Growth Fund, till 2017 when I was managing it, grew 100 times in 21 years. That has become now 400 times.
Yeah.
Now I don't see too many stocks which have become 400 times in 30 years. In fact, in Reliance, we had an investor who had put a board outside his house that this house has been made due to investments in Reliance Growth Fund.
Wow.
So for a retail investor, it will be very difficult to pick one stock and say after 20 years it will be 100x, because it might work, it might not work. So you have picked one stock, but there might be 100 which have not given that. And when you are investing in a diversified portfolio, the chances are much higher.
Okay, but that's also very good advice, right? For someone who can look at a diversified fund right now, start your investment, maybe you will be able to build a house in the next 15, 20 years as well.
You will definitely be able to build a house.
So that's the optimism that we should look at. But thank you, Sunil, so much for joining us on the show. Always a pleasure.
Thank
to
you.
speak
Happy
to you.
Diwali once
Happy
again.
Diwali. So that was Sunil Singhania, a candid conversation from a multi-bagger. You're talking about multi-bagger portfolios with mutual funds from here on, and that's going to be the story for India.